Every year in Augusta, Georgia, homeowners near the Masters Golf Tournament rent their houses to tournament visitors for an entire week and pay zero income tax on that money. This is not a loophole. It is a specific provision in the tax code IRC Section 280A that exempts rental income when a homeowner rents their residence for fewer than 15 days per year. Business owners have used this same provision to rent their home to their own company, receive tax-free income, and give their business a fully deductible expense, all completely legally. Most self-employed people have never heard of it. Section 280A, Gay, of the Internal Revenue Code states that if you rent your personal residence for fewer than 15 days per year, you do not report that income on your tax return at all. It does not go anywhere. It is not listed. The IRS does not tax it. This rule was originally written with short-term tourist rentals in mind, hence the Augusta connection, but it applies to any qualifying rental of your personal residence, including renting it to your own business for a legitimate business purpose. Here is what the strategy looks like in practice. You own a business structured as an S Corp, C Corp, or partnership. Your business holds its annual board meeting, strategy retreat, or employee training at your home. Your business pays you a rental fee for use of the space, the same rate a comparable conference room or meeting venue would charge. Your business deducts the rental payment as an ordinary business expense. You receive the payment personally and pay zero income tax on it because the 14-day exemption applies. The numbers add up quickly. A comparable conference room rental in most mid-sized cities runs between $500 and $1,500 per day. If your business holds 14 days of legitimate meetings or events at your home, strategy days, team retreats, client meetings, training sessions, the rental income can reach $7,000 to $21,000 per year. Every dollar of that is tax-free to you. Every dollar is deductible by the business. The net tax benefit for someone in a 30% combined federal and state rate on $14,000 in rental payments is roughly $4,200 in taxes avoided. The strategy only works under specific conditions. First, your business must be a separate legal entity. It does not work for sole proprietors paying themselves from the same Schedule C. Second, the rental rate must be fair market value, what you would actually pay to rent a comparable space. You cannot charge $5,000 per day for a living room when comparable spaces rent for $400. Third, and most critically, there must be a genuine business purpose for each rental day. This is not a paperwork exercise. The meetings must actually happen. The IRS looks at 4 things when evaluating this deduction. Was there a legitimate business purpose for each rental event? Was the rate consistent with fair market value for comparable spaces? Did the meeting actually occur? Is there documentation? Fair market value is established by getting quotes from local hotels, conference centers, or co-working spaces for comparable square footage and amenities. You do not need to be expensive. You need to be comparable. A rate that is wildly higher than local market rates is an audit flag. The documentation that makes this strategy audit-proof is straightforward. Create a written rental agreement between your business and yourself as the homeowner. Specify the rate, the dates, and the purpose. Keep meeting agendas, attendee lists, and notes for each rental day. Your business writes you a check or transfers the money formally. You do not just move money between accounts informally. The paper trail should make it immediately clear to any examiner that this was a real business rental of a real space for a real purpose. A common mistake is trying to apply this strategy to a sole proprietorship. If you file a Schedule C, your business and your personal finances are the same entity for tax purposes. You cannot rent from yourself in a way that creates a genuine tax benefit. The Augusta Rule works because there is a real legal separation between the business entity and you as an individual. If you are currently operating as a sole proprietor and you want to use this strategy, the first step is formalizing the business structure. The strategy pairs well with other legitimate business uses of your home. If you already claim a home office deduction, the same space can be used for the Augusta Rule rental days. There is no conflict as long as the home office is a separately defined area and the rental days reflect actual business meetings in that or other areas of the home. Your tax professional should coordinate these deductions together to make sure they are not double counted and that the documentation supports both. Talk to a CPI who works with small businesses before implementing this. The strategy is legitimate, but the execution details, fair market rate documentation, entity structure, meeting records, determine whether it stands up under scrutiny. Done correctly, it is one of the few mechanisms that allows a business owner to move money from their company to themselves with zero income tax. If you want the other major self-employment tax strategy that most business owners miss, one that can shelter up to $69,000 in income per year from federal taxes, our video on the solo 401k covers the exact setup and the contribution math.